Okay, so you've sent us a fascinating piece today from the Motley Fool, and it's all about the S&P 500.
That's right.
Now, as we know, the S&P 500 is actually down, what, about 10% so far this year? This is as of last Thursday, April 17th.
Roughly 10%.
So I guess the immediate question that pops up is, why on earth would an article suggest now is a good time to think about investing? Seems a bit counterintuitive.
It does on the surface, yeah. And that's really what we're going to unpack today.
Right. Understand the logic behind it. So we're looking at this market analysis, this financial perspective.
Yep, from a well-known source, the Motley Fool. And it tackles that very question. Is this dip, a warning sign, or is it maybe an opportunity?
Okay, let's get right to it then. What's the core argument, the main thesis of the piece?
Well, the author, David Jagielski, basically argues that despite this downturn we've seen in 2025...
The 10% drop, yeah.
Right. For long-term investors, people looking out years down the line, investing in S&P 500 ETFs could actually be a surprisingly smart move. He even used the phrase no-brainer, potentially.
A no-brainer. Okay. Strong words. And part of that is how easy it is to actually do it, right? Through ETFs.
Exactly. That's a key point. Investing in the S&P 500 is, well, pretty accessible now thanks to exchange-traded funds, ETFs.
And the article mentions one specifically.
It does. It highlights the SPDR S&P 500 ETF, ticker symbol SPY. It's one of the biggest and most popular ways to track the index.
And the efficiency caught my eye, too. The cost.
Oh, yeah. The expense ratio for SPY is mentioned as just 0.09%.
0.09%. That's, incredibly low.
It really is. Less than 1/10 of a cent for every dollar you invest going towards fees each year. Over time, that makes a real difference.
And how well do these things actually track the index? Is it like an exact match?
It's remarkably close. The article points out that over the last decade, the total return of SPY, and that includes reinvested dividends, has been almost identical to the S&P 500 index itself.
So you're essentially getting the market's return minus that tiny fee.
Pretty much, yeah. It shows how effective these funds are at just mirroring the broad market.
The article gives an example that really drives this home, the historical growth.
It does. It talks about investing, say, $10,000 into SPY 10 years ago.
Okay.
Even with this year's dip factored in, that $10,000 would have grown to roughly $30,000 today.
Wow. So a threefold increase, basically, over a decade.
Yep, about 200% growth. It really highlights that long-term power of the index, beating inflation and riding out the bumps along the way.
Even the recent bumps.
Exactly. It speaks to the general upward trend of the U.S. market historically, even with these pullbacks we see sometimes.
Which brings us to why we might be seeing this pullback now. The article talks about a market correction. Can you break that down a bit?
Sure. So think about the last couple of years. The S&P 500 had really strong runs in both 2023 and 2024, right?
Yeah, up over 20% each year.
Which is way above the historical average annual return.
Right.
Which is closer to, say, 10%.
Right.
So after periods like that, really strong growth, it's not unusual for the market to kind of take a breather, to cool off a bit. That's what we often call a correction. A recalibration of prices, if you will.
Like catching its breath after a sprint?
Sort of, yeah.
Okay, now this is where it gets a bit more technical, but really interesting. The CAPE ratio comes into play.
Ah, yes, the cyclically adjusted price-to-earnings ratio.
Sounds complicated, but the idea is to get a longer-term view of market valuation.
That's exactly it. Instead of just looking at current PE ratios, the CAPE ratio averages company earnings over the past 10 years.
Ah, so it smooths out the short-term ups and downs in earnings.
Precisely. It gives you a better sense of whether the market overall looks expensive or cheap compared to its own history.
And where was this ratio before the recent drop?
The article mentions it had climbed up to around 37 before this 2025 sell-off started.
37? Is that high?
Historically, yes, that's quite elevated. The article points out the last time it was around that level was back in 2021.
And what happened after that?
Well, 2022 saw a pretty significant market decline, didn't it? The S&P 500 dropped over 19%.
Okay, so a high KP ratio preceded a big drop. That seems like a warning sign.
It can be, yeah. It suggests investors are perhaps overly optimistic or willing to pay a very high price for earnings, which might mean the market is a bit frothy, potentially due for a pullback.
But where is the TAPE ratio now after this 10% dip?
It's come down. The article says it's now around 33.
So still above the long-term historical average, which you mentioned is closer to 17.
Right. The historical average is much lower. around 17 or so.
Yeah.
So 33 is still elevated compared to the very long run.
But lower than 37.
Definitely lower. It suggests some of that froth or extreme valuation has come off. Valuations are maybe a bit more reasonable now than they were just a few months ago.
But still not exactly cheap by historical standards.
No, probably not cheap. But it's a relative thing, right? Less expensive than it was.
Yeah.
And the key thing here is the KPE is a long-term indicator. It doesn't predict tomorrow's price.
Got it. So this reduction in the valuation, even if it's still relatively high, ties into the article's main point about maybe buying now.
Exactly. It leads right into the argument about potentially buying during a time of weakness.
The idea being?
Well, the fundamental logic is simple. You're buying the same assets, those shares in the S&P 500 companies, but at a lower price point than they were recently.
Buying low, essentially.
Kind of, yeah.
Yeah.
If you believe in the long-term growth of the market, getting in at these relatively lower valuations, even if they're not rock bottom, could lead to better returns down the road compared to buying when everything felt, sky high.
So you potentially benefit more when the market eventually recovers, which historically it has tended to do.
That's the theory.
Yeah.
Of course, the article rightly adds the caveat that further declines are always possible. Nobody knows the exact bottom.
Important disclaimer. And speaking of disclaimers, the article includes some standard ones too, right?
Yes, absolutely crucial for transparency. It explicitly states that the author, David J. Yelsky, and the Motley Fool itself don't hold positions in the SPDR S&P 500 ETF.
So no direct financial interest in recommending it.
Right. And they include their standard disclosure policy, which is good practice in financial writing. Readers should always be aware of that stuff.
Okay, so let's try and pull this all together then. What's the main takeaway from our deep dive into this Motley Fool piece?
I think the core message is this. For investors focused on the long term, this current dip in the S&P 500, maybe around 10%, shouldn't necessarily scare them off.
Instead, it might be an opportunity.
Potentially, yes. The argument rests on, one, the strong historical performance of the index over decades.
The $10K to $30 a K example.
Right. Two, the idea that this might just be a natural correction after really strong gains in 23 and 24. And three, the fact that valuations, well, maybe not super cheap historically, according to Chapier, are less stretched than they were, potentially offering a better entry point for future growth.
And doing it through something like the SPY ETF makes it low cost and straightforward.
Exactly. Simplicity and low cost are big pluses. So the article frames it as something worth considering now, despite the negative headlines, if your time frame is years, not months.
Makes sense. It definitely provides a different perspective than just looking at the recent downward arrow. Which leads us to a final thought, really, for everyone listening. When you consider all this, the historical data, the valuation analysis using things like the TAPE ratio, what factors would actually give you the confidence to invest during a market downturn like this?
Or, conversely, what makes you hesitate?
Right. What holds you back? It probably comes down to your own situation, doesn't it? Your investment horizon, how much risk you're comfortable with, your overall financial goals.
Absolutely. Thinking through those personal factors in light of this kind of analysis is key to making informed decisions, not just following a headline, but really considering if it fits your plan.